in my career, whenever I heard someone talk about an investment return and a church position in the same sentence, I said, I don't like the direction this is going. And I either walk away or I make sure that they stop. No one should ever use a church position as a way to support why you should invest with them.
So just because they're a bishop or your elders quorum president or your relief society president doesn't mean that they know you should trust them and that they know everything about investing.
Yeah, so just be careful with that.
Yeah.
And I like this too. We never will have balance in our lives unless our finances are securely under control. We really need to have the finances. And it's interesting that finances is an important part of balance. Okay, so what we've done is we talked about what do you do before you invest. We built a foundation. Now we're talking about, we also talked about applying the principles. As we talk today, think through. And I think you'll see that as we talk about these things, we are truly applying the principles that we talked about. But we'll talk about asset classes and benchmarks. We'll talk about investment vehicles and objectives. And then we'll talk about what makes a good mutual fund. So we've got a lot of stuff.
And we barely get to what makes a good mutual fund.
So we've got a lot of stuff to talk about today. But make sure you do the reading beforehand. Make sure you read after. And then if you have questions, don't hesitate to answer those questions. As Sister Sudwigs and I go through your questions every day, it helps us to get a sense by listening to your questions where you are. So someone define an asset class for me. What are asset classes? Have you heard that term before? Who has never heard of the term asset class? It's okay. Okay, a few people here. So what an asset classes are just groups of securities with similar characteristics. So you've heard of major asset classes with cash, bonds, equities. They're also called fixed income and stocks. But securities with similar characteristics, such as the type of financial assets. It can be stocks or bonds or cash. Market capitalization. That market capitalization is just how many shares do they have in the company and what's the current price. So it's a measure of size. Roughly, large cap stocks, large capitalization stocks are stocks that have a market cap greater than 10 billion. Mid cap is somewhere between 2 and 10, and small cap is 2 and below. And that varies. Then maturity, are you buying bonds that have a long maturity, or are you buying bonds that have a short maturity? So short, mid, long term, and then geographic location. You could have international stocks or international bonds, or emerging market stocks and bonds. So again, why are asset classes important? Because your choice of asset classes, so you want to build your portfolio based on asset classes. And your asset classes determine your risk level. You put everything in government bonds, are you high risk or are you low risk? Yeah, you're very low risk because the government can always print new money. If you put everything in crypto, are you high risk or low risk? Very high risk. And what's the principle? We want to be diversified too. So how have most asset classes done? This is a log scale. Notice the difference from here to here is 10. 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 Log scales are used when you've got data that covers wide periods. So notice if you would put $1 in a portfolio of small cap stocks in December of 1925, at the end of 2023, you would have $52,000. If you were to put $1 into large cap stocks, you'd have almost $15,000. If you'd put $1 into your long-term bonds, you'd have roughly $150. If you put $1 into your short-term bonds, you'd have $22. And if you did nothing, inflation has increased 17 times over that time period. So that gives you a sense. What do you notice about this chart? How volatile is it? It's volatile.
But it's going up.
Is it up and sloping? Yeah. Well, let's go with a little bit more detail. So now what we did is we calculated what was the 1-year return. Okay, this period ended December 31st, 2023. So 2023, the S&P was up, which is large cap, was up 26%. Over 5 years, it averaged 15% a year. Over 95 years, it averaged 9.7. Realize that is for a portfolio of 500 securities, not just a single stock. Small cap did even better. There's an interesting thing here. There's called standard deviation. So what's standard deviation? You've had it in your finance classes. It's a measure of volatility. How volatile is it? And so what we've got here is, notice large cap had a standard deviation of 18, and this is 28. So it's significantly more volatile. It means you've got a lot more chance of higher and lower returns. Treasury bonds, you can see average around 5.2%. Again, less. Treasury bills, 3.2. Notice how small this standard deviation is. So again, a lot less variability around the mean. Now, we don't have 100, at the end of this year, we'll have 100 years of data. But we don't have that too. But for international emerging markets and REITs, we have at least 25 years of data. So again, what does this show over most times? Over longer periods of time, these things do tend to perform. But there's lots of things we can learn from this chart. Number one, again, over short-term periods, it can be volatile. Over longer-term periods, though, the returns have been good. So let's talk a little bit about asset classes. Major goal of cash or short-term investments, what do you want? What does it give you? This is your emergency fund. This gives you liquidity, capital preservation. You don't want to lose money. So different types of instruments, high yield savings, your bank savings account, but also money market mutual funds, short-term bond funds. Also, in this category is short-term government securities too, or short-term muni bonds. So what do we like about cash? Cash assets, they offer liquidity and stability of principal. Low risk. You're not going to lose much. You're not going to lose things with cash assets.
Only to inflation.
Only to inflation. So if you're someone here that's going to be here for 3 more years, would I invest in the equity markets? Probably not. Then you're going to go back to your home country. I'd probably yield in high yield savings. Anything I can get the highest return short term. What's the risk? Disadvantage? Again, you won't get much of a return. But you can, by looking around and doing your homework, you can find higher returns. And really, the returns on cash and cash equivalents, they're generally unlikely to keep up with inflation. And then we've got fixed income. What's the goal of fixed income or bonds? You can hand that out if you want.
Okay.
You want returns in excess of inflation. You won't get a lot in excess of inflation, but in excess of returns are higher than cash, but generally, hopefully, you'll beat inflation with it. Lots of different types of fixed income assets, taxable bonds or taxable bond funds, tax-free bonds, tax-free bond funds. Again, this is the US. And realize that most of these bond funds, they have short-term maturities, which is a year or less. Intermediate term, like is 2 years to 10 years, and long-term maturities, it's 10 years and beyond. When are fixed income asset classes? When do you build your portfolio? Why would you put fixed income asset classes in your portfolio? Number one, they offer greater potential return and risk than cash. And they're a good diversification tool with your stocks, because generally stocks and bonds don't move exactly together. What's the challenges? Generally, the returns have been lower than stocks. And bonds are much more susceptible to interest rate risk. As interest rates change, the value of your bonds change. So what do we find with bonds for long term? Alone, they're really not a good long-term investment. But if you include them with stocks as your long term, they're a good diversification tool. And again, your bonds need to be part of an overall portfolio. So Sister Sudwick's has handed out this sheet here that talks about, again, taxable and tax-free bonds, bond funds, U.S. and international taxable funds, and then government, different things like that. Again, what have we done? We've given you a lot more information. And when you have time, you can spend on. We just don't have a lot of time to go over this in detail. So we'll encourage you to do this on your own time. And then we have our equity or our stock asset classes. With the bond, what you're doing is you're lending money to the corporation. And it's an agreement that you lend them money and they'll pay you a certain amount of interest every year. And after a certain number of years, they'll give you your principal back. With the equity or stocks, what you're doing is you're buying an ownership share of the company. So you own part of that company. So with our kids, when they were first born, we would put money in an index fund for them to save for their missions and for their educations. So from very young, they were shareholders in 500 of the largest companies in the U.S. When you buy an index fund, you are a shareholder in or if you do the S&P 500, in one of the 500 largest companies in the U.S. But stocks are ownership. So how have they done? What's their purpose? Just growth and return, and earn returns in excess of inflation. This is really the only asset class that has consistently outperformed inflation. Lots of different types, large, mid, small capitalization stocks. There's different things, value and growth and blend stocks. Value means they're cheaper than the average. Growth means they're going to grow faster. I prefer just to blend when I invest just because it gives me some value and some growth. And then geographic area, they're US stocks, international stocks, global stocks. What's the difference between global and international? International means that these are companies from companies outside the US. And if it's global, it's international stocks plus US stocks as well. And then you've got emerging market stocks, which is what I worked in for many years. Advantages of equities, they've had the highest return of any of the asset classes. So growth and value tend to perform in alternating cycles. It makes sense to own both, which is what we do. And really for long-term investing, these are these do the best. So Sister Sedgwick and I, we were estimating how much of our retirement money has come from long-term investing, and we think that the market's delivered about half of our retirement assets. So you could just invest in banks, and it's not going to grow very much. But we've tried to invest long-term and with good asset classes over long periods of time, and it's covered a lot of our retirement. What are the disadvantages? Less stability, subject to short-term price fixing. People are excited because the S&P this year was up 25 and last year was up 27, but the year before it was off 18%. So when you have these asset classes, you have to be willing to take that they're going to have ups and downs. But again, if you can kind of think long-term, what's happening, you'll do a lot better. I remember 1987, we started our first company 10 days after the crash of 87, and it seemed like the world was falling in. 2007, 2008 seemed really tough. But you know what we did when the markets, everything crashed in 2007 and 2008? We continued investing our 20% into the market. And with 2 years, it had doubled from the bottom. So again, if you're only investing for 3 to 5 years, I think only a small portion of your portfolio should be in equities. But if your perspective is 5 years and beyond, I think equities are a great part of your portfolio. Okay, do you want to hand this one out too?
Yep.
So again, a lot more information than we want to cover right here in the class, but we're giving you these summary sheets just to help you understand and to put back. And then when you want to go into more detail, you'll find that these summary sheets have a lot of detail there too. So let's look about risk. Again, what we did is we talked about volatility as a measure of risk. What's the least risky on fixed income? Cash, CDs. Now we'll take a little bit more money markets, a little bit more government bonds, a little bit more corporate bonds, junk bonds. Junk bonds are for companies with very low risk, or very high risk, I should say. So again, high yields, but high risk too. And then on equities, What's the least risky? Large capitalization. And then as these, you're getting a little bit more risk, a little bit more risk, and a lot more risk. You know, someone in my last class, he commented, he says, well, President Trump just did something with equity or with cryptocurrency, so shouldn't we have that in our portfolio? And I said, I don't mind you having 1 to 3% in your portfolio, but do cryptocurrencies offer a dividend? No. Is there a value there? There's no intrinsic value. The only value is what someone else is willing to pay. It's kind of the same thing for gold. So be careful. Be careful of what you invest in. And again, as you choose your asset classes, you choose your risk level. I like this chart here too. So you've got risk this way, which most is just volatility. On this side, you've got returns. So cash and cash out, your savings accounts, your CDs. High yield savings are probably around here. Then you've got your fixed income asset classes, government bonds, mutual fund, bond mutual funds. Then you'll continue up. You know, you've got large company stocks, small company stocks, real estate, business ownership, and then you've got your funds there too. Yes?
Why real estate is a high risk?
Because it's very susceptible to a lot of different factors. So, and how did we get this high risk? We can actually just look at the standard deviation over time. So if you look at that chart, you can actually see what the returns on real estate have been and what the returns on real estate, the volatility of real estate has been. Real estate sometimes is kind of that flavor of the month where people get really excited. But real estate, gold, crypto, the key is the principle is to be diversified. And that's what we want to do. We want to build our portfolio with asset classes.